Thank you, Rashid. Thank you so much for having me. I do appreciate you having me on to talk about my favorite subject, responsible investing. And I thought before I got going into the presentation, I would tell the story of how did I come to be focusing in this area. And so I've been an advisor for about 10 years. And at the 10-year juncture, I was kind of feeling like, is this what I really want to do? And I was thinking possibly of changing hats and doing something else. And I read a book, and actually this is the book here. It's called Investing for Change and How to Profit from Responsible Investment. And in the very first chapter of this book, if I can share, it talked about a company called PetroChina, and how PetroChina, it says, according to the Save Darfur Coalition, 70% of the Sudanese government uses up to 70% of its oil revenues generated mainly from foreign direct investment to give arms and supplies to the Janjaweed militia accused of the killings in Darfur, where they went in and there were all kinds of acts of genocide, raping women and girls, and just awful. And the next paragraph I read, right close to the very beginning of the book, said, if you learned that through your mutual fund holdings, you are one of the many shareholders of PetroChina, would you care? And if you sold your shares, would your actions change the way PetroChina does business? And when I read this and it said, if you knew that you held PetroChina in your portfolio, would you care? I was like, hell yes, I care. And then I kind of scared myself because I was like, I care. And prior to this, I feel like I was somewhat living under a rock, not really paying attention to anything social or environmental that was happening. And I was just living my life, raising my kids. And so this put me on the path to learning more about responsible investments. I joined the Responsible Investment Association, and I learned everything I could about responsible investing and the options that are available to investors. And as a result of that, I started meeting my clients and introducing responsible investments to them and helping them to see how they could impact our world and our environment by choosing to invest responsibly. So I'm hoping that by the time I finish today, I would have left an impression on you where you would actually take a look at whatever you would potentially be looking at investing in and try to choose responsible investments as the way that you would choose to grow wealth. So what I'm going to do while I start this presentation is I'm actually going to share my screen, but I'm going to turn my camera off just to make it a bit more efficient for me. So just bear with me 2 seconds. Okay, I hope everyone can see that. And now I'm just going to just turn my camera off just for this part. So we are going through the Greening Your Portfolio presentation. I'm just going to get to the agenda. So what I hope to cover today is what is responsible investing, short-term RI, how does responsible investing work, why does it matter, and give you a summary of the market trends, what we see from consumers and what they care about. And then we'll have some time for questions at the end. So what is responsible investing? Responsible investing is the incorporation of environmental, social, and governance factors into the investment decision-making process. And the terms above all have a slightly different meaning, but they all have played a part in the history and development of responsible investing. So responsible investing is an umbrella term that encompasses all investment approaches that consider ESG factors. Sorry, I forgot to change the slide. So SRI, community investing, social finance, green investing, ethical investing, all of these terms is what responsible investing encompasses. So what are the issues? So there's a variety of ESG issues. A few of the examples are climate change, water scarcity, supply chain, executive compensation, corporate diversity, and Aboriginal and community relations. And we're going to look at a few of these. Climate change is a critical threat to the global economy and the ecosystems we depend on. And in 2014, the Intergovernmental Panel on Climate Change concluded that climate change will affect all sectors of the economy, and they stress that it is relevant to investors and financial institutions. Climate-related events disrupt investment markets and erode the long-term profitability of companies. As extreme weather events wreak havoc on business operations and supply chains, financial risks to investors will be amplified. Canada is a major producer and exporter of fossil fuels, and high carbon industries play a large role in the Canadian economy. This presents a unique challenge to us as Canadian investors. With regards to the supply chain, in 2013, there was a collapse of the Rana Plaza in Sabah, Bangladesh, which attracted worldwide attention. The deaths of more than 1,100 garment workers showed how a company's business decisions have serious consequences for workers. And they also underscore the reputational, operational, and legal risks associated with human and labor rights in the supply chain. With regards to water scarcity, globally, climate change is already affecting water patterns, leading to droughts in some areas and floods in others. Water is an important issue to investors because companies, especially those in water-intensive industries, face significant financial risks. These risks include business interruptions directly through local infrastructure or indirectly through suppliers, and the potential market impact of negative media attention if a company is affecting a local community's water supply or quality. And then with regards to diversity, a board should reflect the diversity of their workforce and society. And there is a positive correlation between the presence of women on boards and financial performance. There was a study done in 2012 of 2,360 companies by Credit Suisse, showing that companies with women on their board increased returns, improved growth, and increased value, just because women are awesome in general. The study found that companies with women on their board delivered above average returns on equity, better average growth, and higher price to book value multiples over a 6-year period. In 2013, the collapse of the Rana Plaza in Sabah, Bangladesh attracted worldwide attention. The deaths of these 1,100 garment workers shows how many business decisions have serious consequences for workers. So when you look at this picture, we can see that this is a photo of an all-male white board directors of a Fortune 500 company. Around 40% of Canadian boards look just like this, with not a single woman on the board, and women hold only 16% of all board seats in Canada. This is not only an ethical issue, it's also a business issue because research has shown, as mentioned, that companies with more women in leadership tend to outperform on a number of financial metrics. And here we have discarded plastic bottles and other garbage blocks at the Vaca Dam near the Bulgarian town of Krichim. Single-use plastic containers like bottles and plastic bags are the biggest source of trash found near waterways and beaches, according to the non-profit Ocean Conservancy. Imagine an area 34 times the size of Manhattan. Now imagine it covered ankle deep in plastic waste, piles of soda bottles and plastic bags, takeout containers by the mile, drinking straws as far as the eye can see. That's a total of about 19 billion pounds of garbage. And according to one of the best estimates available, that's how much plastic waste ends up in our oceans every year. And that figure is on track to double by 2025, unless something is done swiftly and at a global scale to stem the tide of garbage. So what we want to look at now is some of the policies in place that are needed for us to move the change along as far as the climate goes. Scientists largely agree that we need to limit global warming to 1.5 to 2 degrees Celsius to avoid catastrophic consequences. As a result, world leaders signed the Paris Agreement in 2015 to make pledges to keep global warming below 2 degrees. And we all know that America are no longer part of that deal, but enough said about that. However, as shown in the chart above, the red shading indicates that these pledges will put us on track to exceed the safe levels of warming. And as shown in the light blue area, current policies do not even put us on track to meet the Paris Agreement. At our current rate, we will see somewhere between 3.1 to 3.7 Celsius of warming. This puts us on a path to dangerous climate change, so it's prudent for investors to consider their exposure to climate risks and opportunities. So there's a lot of growing awareness now with regards to ESG and responsible investing. Responsible investing isn't just about values anymore. There's a growing evidence that RI reduces risk and leads to superior long-term financial returns, and it's about managing risk to long-term shareholder and stakeholder values. So how does responsible investing work? If there are any questions, you can stop me, interrupt me, and I can take a beat if needed. Otherwise, I'll just continue. So responsible investing uses various strategies. There's negative or positive screening, ESG integration, shareholder engagement, or thematic investing and impact investing. So what that means is there are several different strategies available for investors to incorporate the ESG considerations into their portfolios, and it's not just about exclusions. The negative screening, it means excluding from a fund or a portfolio or certain sectors, companies, or projects based on ESG criteria, for example, divesting from certain industries. Positive screening is the inclusion of certain sectors, companies, or projects based on positive ESG performance relative to industry peers. For example, impact investing, best of sector. ESG integration is explicitly embedding ESG issues into traditional financial analysis. Integration is different from screening in that integration combines ESG data, research and analysis together with traditional financial analytics in making investment decisions. Corporate engagement or shareholder action is using the shareholder power to influence corporate behavior directly. Examples are engaging in dialogue with a company, management of boards of directors, filling or co-filing shareholder resolutions and voting proxies based on ESG criteria. Impact investments are targeted investments typically made in private markets with the explicit purpose of solving social or environmental problems. Impact investing includes community investing, financing for green business, social entrepreneurs and other companies with clear ESG objectives, enterprising, revenue generating nonprofits. Sustainability themed investing is investments in themes or assets specifically related to sustainability, such as energy efficiency, clean energy, green infrastructure, adaptive solutions. And you might ask yourself, why does responsible investment matter? Why do institutional investors care about ESG? So an example of an institutional investor that cares about ESG would be our very own CPP, Canada Pension Plan. The Canada Pension Plan has integrated ESG considerations into the investment making decision because they see that there are material risks that the investor is exposed to. So they see the need to protect the pension of Canadians by incorporating these ESG practices. And so minimizing risk for us over time, improving returns over time, meeting our client beneficiary demand, and fulfilling their fiduciary duty. And I want to spend some time just giving an example. So we've sort of talked about the strategies that are used in developing financial solutions that incorporate these different types of integration for ESG. But just to give an example of companies that we are all familiar of that have been in the news due to something terrible happening, and that has caused their stock price to drop. So the first one that I thought we'd look at is BP Oil. So I'm sure most of you have heard of BP Oil. On April 20th, 2010, commonly known as the 2010 Deepwater Horizon, an oil well blew out and caused an explosion on an offshore platform in the Gulf of Mexico. The BP oil disaster was the single largest marine oil spill in the history of the petroleum industry. Oil flowed from the rig at a rate of 53,000 barrels per day for a period of 12 weeks. It's estimated that 4.9 million barrels were released into the local environment. The event resulted in the deaths of 11 people, 17 serious injuries, massive erosion of marine and wildlife habitats, and devastation for local fishing and tourism enterprises. Between 2007 and 2010, the US Occupational Safety and Health Administration found that BP Oil had incurred 760 egregious, willful citations across 5 refineries, the most dangerous citations that an organization of their type can receive. And within 2 months, BP's stock dropped 55%. To this day, the stock has not recovered. As a consequence of the 2010 oil spill, it's cost up to $25,000 more a day to drill a deep water well. Companies are drilling farther from shore and in deeper waters. New regulations have prompted companies to add safety features such as an extra stack of valves designed to stop an out-of-control well. So we can see that if you had invested in BP oil and maybe a considerable amount of your portfolio was in this particular stock and you were close to retirement, then you would definitely experience a dramatic fall in the value of your portfolio because of this risk. And this is a company that had been given so many citations, had taken no action, and until this publicity happened, nothing was really done. And the fallout from that was definitely very material. The other company that I thought we could look at is Volkswagen. So the German car maker Volkswagen scandal is commonly known as the diesel dupe and emissions gate. In September 2015, the Environmental Protection Agency found that many Volkswagen cars that were sold in America had software called defeat devices that could detect if they were being tested. This software would change the performance to improve the results. Laboratory emissions testing found that the emissions emitted were 40 times more than regular cars and it contributes to acid rain and smog. After September 17, 2015, the stock price fell by 40% by October 2nd, 2015. So two cases where because of negligence and poor business practices, those people that would have been invested in these two companies would have experienced dramatic losses and reductions in their investment portfolios due to these scandals. So this is definitely proving that investing in companies, I remember just sidetracking a bit, that when this Volkswagen scandal happened, I remember having conversations with the investment companies that I work with and asking them if they owned Volkswagen. And I remember that one of the answers I got back was that they didn't own Volkswagen. I think one company did, but the rest of them, they said they didn't own Volkswagen. And the reason why they didn't was because during the ESG screening process, when they looked at the board of Volkswagen, they saw that two families seemed to control everything and they couldn't understand the board structure. And although over the years they got a lot of flack for not owning Volkswagen, as they were, a profitable company, they're just putting the ESG practices in place helped to protect them when this scandal happened, because they didn't own them. And the simple reason was that when they look at the screening criteria, they couldn't understand the board, and therefore they didn't feel that there was too much room for corruption, is what they pretty much said from what they saw of the board structure. So it's kind of interesting to see how applying ESG to investment criteria helps to protect investors from situations like this. Before I go into the next slide, which is more about the performance of responsible investing, does anyone have any questions that I need to address at this time?
Nothing from the audience right now, Carol, so you can keep going.
Okay, we'll keep going. So then the question that you may have is, can I make any money from responsible investments? Well, the good news is that I'm going to show you this chart here. So this chart is showing the performance of an index, the Jantzi Social Index. And the Jantzi Social Index is an index of 60 Canadian companies with strong ESG performance. And the chart above shows that the Jantzi Social Index has outperformed the TSX since inception in 1999. So you can see from this chart that investing responsibly gives you equal to outperformance of the broader market. So you're not giving up anything to invest responsibly. And then just to give a bit more further detail, when we compare the responsible investment funds with their counterparts in the same asset class, when markets are down, they're down less, and when markets are up, they have greater performance. So we can see that in this case here, we have Canadian equity and we have global equity. In both cases, the responsible investment, which is the blue bar, has outperformed. So not going down as deep when markets are down and outperforming when markets are up. So getting more of the upside, less of the downside. And the same with the global equity balance and the international equity. So in the various asset classes that are sort of like the most important within the average Canadian portfolio, responsible investments are outperforming. So they're providing downside protection as well as upside gains. One of the things that we've actually learned is that Canadian retail investors really do care. So 71% of them agree that companies with good ESG practices are better long-term investments. 81% are concerned about climate change. 81% know little or nothing about responsible investing. We know that millennials get it. My kids get it. Like things that I was having an aha moment about. My kids already knew about that, learned about it in school. And we see that millennials are 2 times more likely than baby boomers, which I'm a baby boomer, to be interested in investments dedicated to solving E and S problems. And 20% of women are more likely than men to believe it's important for their advisor to be knowledgeable about responsible investing. So we see that this is something that investors want, and they want transparency in their investments. They want to understand how they're impacting their environment and if their investments are in alignment with their values. Investors want to be informed. 82% of Canadian retail investors somewhat or strongly agree with this statement. I would like my financial advisor or financial institution to inform me about responsible investments that are aligned with my values. So this is something that every single person I've ever spoken to asked about responsible investments, they think that this is something that's very important, but as advisors, we're failing to talk to our clients about responsible investments and to let them become aware that this is something that's available. Because if you are an investor and you walk into a bank tomorrow morning and you say, I'd like to open up a TFSA account, a tax-free savings account, or an RSP account, or I want to do education savings plan for my children, and you don't specifically ask the bank and say that you want to be invested responsibly, then you may inadvertently be invested in weapons. You may be invested in tobacco. Many people have lost relatives through smoking and would not necessarily want to support the tobacco industry. And a lot of people definitely, like if you were in a room full of people and you said, how many people want to be invested in guns? How many people do you think would put their hands up? Probably none of us. But truth be told, even though we wouldn't want to be invested in it, if we go to a bank or wherever and we were invested and we don't ask questions, then we could inadvertently be invested in things that are not in alignment with our values. Does somebody have a question?
Yes, we do have one if you want to get to it right now, Carol.
Yeah, sure.
Okay, so one question from our audience right now is, how would you determine which equity fund to select? Can you review their RI metrics to see if they are aligned with your own values?
You can. The off the cuff, there's initially most investment companies that offer responsible investment funds, they will give information about the screening that they do. So no weapons, no nuclear, no tobacco, no gambling, no adult entertainment, no doing business in countries where there are repressive regimes and things like that. So each company will have this type of information on their website. When building a portfolio, you can't, unless you're actually building a stock portfolio where you're picking companies and you're actually building a portfolio of companies that you've picked, that you vetted, when you are invested in funds that have a responsible investment mandate, it's usually initially the screening process of, like I said, excluding the various sectors. Weapons, nuclear, and tobacco are the 3 minimum that are in responsible investments. And for a responsible investment to be a true responsible investment, there has to be several things. They have to have exclusions of certain sectors. And it could be, like I said, between 3 to 7, depending on the company. They have to have shareholder engagement and proxy voting. And so all of these things have to incorporate a responsible investment. So when you're choosing one, you have to make sure that it's not just ESG integration, as I mentioned earlier, which is something that CPP does, meaning that they look at the E, the S, and the G of projects of companies that they own before they would actually invest in it. And similarly, some investors don't want to be invested in banks, for example, because they say, how are banks responsible? Because banks fund a lot of the fossil fuel industry. But in 2013, the large 5 or 6 banks that we have here in Canada, they became signatories of the Equator Principles. And those principles are basically saying that for projects 10 million and 100 million, depending on what they are, they will do the E, the S, and the G screening of those projects to make sure that they are not in any way affecting the environment. It's not something that goes back, as in it's not backdated beyond 2013, but this is something that has been implemented. And yet still, we do know that in the financial services sector, there is that sort of gray area where, banks do fund companies associated with the fossil fuel industry. So I know I said a lot, but hopefully that kind of answers the question, that you have a suite of choices out there, but if you want to make sure that you are being invested responsibly, it's the criteria that's required is there's exclusions, there's shareholder engagement, and then also proxy voting. And beyond that, those companies usually provide a quarterly report which explains what they have done, what engagements have taken place with which companies in which sectors, and what they have helped to accomplish, and what's they sort of give an agenda as to what's on the table for the next engagement that they have. So I hope that explains that. Is that a good response, or?
Yeah, I think that's good for now. And just a reminder to everyone watching, if you do have questions for Carol, just type them into the Q&A panel, and we'll get to them as we go along.
Okay. And then I'll just move on to the next slide then. So this just basically shows the growth and the interest of responsible investments in Canada. You can see over the years, these figures are a couple of years back, but you can see that between 2015 and 2017, there's been a growth of 41% of inflows into responsible investments. And I can actually tell you that even now, there's information that says the early data indicates that RI funds, and this is post-COVID, are indeed losing less than their counterparts, which further strengthens the case for incorporating ESG issues into investment decisions. In the Canadian market, data provided by Fund Data shows that a staggering 83% of responsible investments funds outperformed the average return from assets in the same category in the first quarter of this year, and 80% of the funds outperformed over a one-year period ending in March of this year. So we can see that the S is moving to the forefront, which is this year we saw so many things in the lockdown through COVID. We saw that the S is becoming, social issues are becoming such a huge thing. And actually this week I'm actually on a conference with the Responsible Investment Association to do with diversity and inclusion, which is a huge issue, especially stemming from this year we have the George Floyd killing, anti-Black racism, racism against Indigenous people, and inclusivity to do with gender and so forth. So there's so much out there that we can see that when people do not invest diversely and have these policies in place, they miss out on so much talent and obviously market share because of discrimination or unconscious bias. And so I just wanted to share another thing too, where we see growth in responsible investments is we're finding that more and more investment companies are becoming signatories of the UN PRI, the Principles for Responsible Investments. And just to outline what those principles are, there's 6 principles. In 2006, the UN EPFI and the UN Global Compact launched the Principles of Responsible Investing, and RI moved into the mainstream. So institutional investors became PRI signatories to make a commitment to implement 6 principles for responsible investing. And these are: number 1, we will incorporate ESG issues into investment analysis and decision-making processes. Number 2, we will be active members and incorporate ESG issues into our ownership policies and practices. Number 3, we will seek appropriate disclosure on ESG issues by the entities in which we invest. Number 4, we will promote acceptance and implementation of the principles within the investment industry. Number 5, we will work together to enhance our effectiveness in implementing the principles. And number 6, we will each report on our activities and progress towards implementing the principles, because we know anything that's not measured doesn't usually happen. So this is something that we've seen an increase in. So the signatories of the PRI has grown exponentially since 2006. And this just shows that more and more investment firms and our society at large is recognizing that ESG issues are material and are important when it comes to investment decisions. So in sort of wrapping up, the key benefits of responsible investing are that you're able to align the investments with your values. Just like the question that we had asked earlier. So you're able to recognize what it is that that is not in line with your values and choose to exclude those from your portfolio, you can contribute to positive societal change. And at this point, I just want to add one more thing, and that is that something that I had sort of mentioned when Rashid and I were talking, is that there are two schools of thought about responsible investing. Some people are of the mindset that they don't want to be in fossil fuels, they don't want to own oil companies, pipelines, they don't want to own banks, like they don't want to own this because there's sort of like a never-ending stream of things as to each thing leading back to an area of the market that they don't want to be involved in. But the other school of thought is that in order to have a seat at the table, we need to own the company. And we cannot choose to exclude a company like, say, Suncor and not want to have them in our portfolio when they are a company that needs to transition their business. Because 5 years ago, it was said that oil will become a stranded asset. And we can already see that today, 5 years later. It was actually said it would become a stranded asset within 10 years. And within 5 years from that being said, it's already on track to become a stranded asset. So this is something that is very important to sort of, I guess, to have it in your mind that when you are choosing responsible investments, there is no perfect world and there are no perfect companies, but we can make good companies better companies. And how we do that is by buying the companies and having shareholder engagement, proxy voting, and trying to get them to move change along. We look at situations where when the Rana Plaza had that disaster, we know that Joe Fresh, when we saw it on the news, those of you that did see it, you saw Joe Fresh, the Joe Fresh label was on the news, and we saw that Galen Weston, I think his name is, from Loblaw, he was one of the first people to step up to the mic and talk about what they were going to be doing to help. And they formed an accord where there's a group of people in that same industry get together to put together minimal state safety standards and so on, but they didn't only compensate the people that were affected, but they also helped with the labor laws of the country, because that industry is a huge part of the Bangladesh economy. And so to take away the clothing industry would not, or to shut everything down would not be helpful to that country. So these large companies, they signed this accord, and they got together to work out how they can improve safety for the workers, improve compensation for the workers, and also obviously maintain the industry that was happening there. And because, like I said, just excluding it or just saying let's move the business from Bangladesh to another country isn't going to help that country. Just like Canada is heavily weighted in fossil fuels, for us to just say let's just turn the gas off and just go straight to more energy efficiencies is not necessarily going to happen in Canada, and it's going to have a detrimental effect on our economy. So the other school of thought is that we own these companies when they do show up in a responsible investment portfolio, and it's simply because there is an engagement that's happening, and that there has been something that has been said, timelines that have been given when they will be transitioning to more efficient and sustainable energy. So in addition to that, responsible investments, as we talked about it before, on the downside, we see that they don't go as low as the traditional broader market when markets are down. And so therefore, because recovery is sooner, there's longer term performance or outperformance. And then just to wrap up, if nothing changes, I thought this slide was really good, because according to the World Wildlife Fund, if nothing changes by 2050, we will need 4 planets to sustain projected consumption. If nothing changes, according to the World Economic Forum in 2016, by 2050, there will be more plastic than fish in the ocean. And if nothing changes by 2030, we'll only be able to meet 60% of the global demand for drinking water on our planet, which is very scary. Okay, so before we go to the final trailer that I would like to show you, does anyone have any questions?
We do have one more question that's coming if you want to get to it before we start the last video. So one question here, are there any ETFs that stimulate the investments of the CPP?
So in other words, are are there any investments that are the same as what CPP are holding, is what the question is really.
I think so, yes.
Yeah. I don't believe that there is. However, one of the things I will say about ETFs and responsible investing is that they are out there, and there are some that are doing a good job. Corporate Knights did a very great article where they went through a lot of ETFs that have an RI signature against them, saying that they are green and they used a bunch of trees. So if you got 1 to 5 trees, it showed that when they checked the underlying holdings, that these ETFs were truly green. So I would say that choose your ETFs wisely, because there are ETFs out there that are touting themselves as being ethical, as being fossil fuel free. And there was an ETF that they had spotlighted in the article. I can actually try to find it and send it to you, Rashid, so you can share it, where they showed that there was a fossil fuel free ETF, I think, that had Exxon in it. So, and there was several, the article actually sort of said that those of you who are investing in ETFs, which a lot of millennials do because of the fees and so on, you will choke on your proverbial fair trade coffee when you actually read the underlying holdings in these ETFs that are being touted as being sustainable, ethical funds. So there are good ones out there, but you need to do your homework. So and CPP, that's something even we as the pension people who are part of the pension, we're not really familiar with the assets that are within the CPP pension. So it's just such a massive pension, and the holdings are, we know that they are globally diversified, as are all good portfolios. Their diversification is global, and that we also know that their portfolios don't take on unnecessary risk. So if you're a younger person, you may want a more aggressive portfolio than the CPP pension portfolio. I hope that answers the question. And I'm also available offline too. If anything isn't clear, I can get into that.
Sure. We have a couple of more questions. I think some more questions are going to start coming in now. How about we play the trailer and then we'll transition over to a proper kind of Q&A segment. How does that sound, Carol?
Yep, sure. That's great. So this video is the trailer for a video that you may want to watch. I strongly recommend it. It's 42 minutes. The actual video, this trailer is 1 minute, not 42 minutes, but the actual video is 42 minutes. And it's basically talking about the recovery that we need post-COVID. So it's a current video that's relevant to us right now. And it's showing how we need, the financial services industry needs to restart, and what we need to do in order for us to combat this serious crisis that we have and that we're heading into post-COVID. So it's 1 minute. I'm going to show this, and then I think we'll have some time for some questions. So just bear with me here.
The value we place on a stable natural world will ultimately determine its future. Do we invest money in the practices that take us deeper into this crisis, or in the solutions that could get us out of it?
The problem with climate change is that it's not a quarterly issue, it's a quarter-century issue.
There's over 300 trillion in the global capital markets, and that money can be harnessed to do a great deal of good.
The biggest risk is inaction today.
This is the most well-educated and the most well-paid industry, and I'll be disappointed if we cannot change ourselves.
Okay, I'll just turn back on my video now.
I'll do the same. Welcome back, Carol. Thank you for a great presentation. And yeah, a really poignant way of wrapping things up with that trailer. So much to think about as we are, wanting to do well for ourselves and for our own finances, but of course not doing it at the detriment of the planet that we hold dear. And I think your line about choking on the proverbial fair trade coffee is something that I will certainly take away from this presentation. So Carol, thank you so much for your time today. We'll get to some questions now from coming in from the audience. And a reminder, if you do have questions, just drop them into the Q&A panel, and we'll get to as many as we can in the next little while that we have here. So I think a book called Investing for Change, published in 2008. Would you say it is still relevant, or would you recommend another more recent book or bit of literature?
The Investing for Change book was what I read, but definitely I would say it's outdated. The Responsible Investment Association in Canada, which is RIACanada.ca, it's a wealth of resources for investors to go to and find out which companies are in the responsible investment space. And also you can find, I'm on the Responsible Investment Association website, but you can find an advisor in your area and so on who is certified and who is specialized in this area. So I would say if I was an investor, I wouldn't necessarily go to a book, go to Responsible Investment Association, and there's just a plethora of options for you.
So now for people who are interested in maybe looking at their own portfolios and their own investments, what's the best way that they can sort of broach the subject with their financial advisor or whoever's managing their portfolios?
What I would say is, so I can give you the experience that I had with my own clients. So when I had my aha moment, and I was totally enthralled with responsible investments, and just like I said, I was like a new convert. I just wanted everybody to know about responsible investing. I met with clients and talked to them about it, and I guess in the enthusiasm that I felt, and then we transitioned their portfolios to responsible investments if it made sense. Because sometimes, depending on the stage of life that clients are, they just need to stay where they are and the guarantees and so on. But if you have a portfolio and you have an advisor and you're not invested responsibly, a lot of advisors are not educated in this area. And yet still, even though I am certified and even though it's an area that I have expertise in, any advisor can offer the same things that I can offer. So they can offer responsible investment. It's just that they're not educated, so they will look to you for guidance. They might say, is there a particular fund you want to be in? Which kind of is a bit disconcerting because you're looking to them to be the expert. The younger advisors, I find, are more on board with it, but a lot of advisors just don't have a clue. And so you definitely do have that option to move into responsible investments. I mean, I can tell you that with regards to performance that you can sort of relate to, that this year we have a fund, for example, at Desjardins, there's a fund called the Positive Change Fund, and it invests in healthcare, it invests in impact investing, and all types of different opportunities that are providing resources to people on the globe in various sectors. And year to date, it's up 66%. So, and that's not the typical performance of every responsible investment fund, but that was one of our rock stars. Like, that fund did really well. So even if you had, and it's actually medium risk, it's not a high risk fund and so on. But what I'm saying is that if you're invested with someone already, you already have a portfolio, you can work with that same advisor and transition to responsible investment, or you can find an advisor that has expertise in that area and they can transition you out of those funds into something that's in alignment with your values.
Sounds good. Looks like that's it from the questions for now. If anyone has any final questions for Carol, please type them in. Otherwise, I'll just say thank you to Carol once again for sharing her time and her expertise with us. And pardon me, a reminder that if you are interested in learning more about the various ways that you can support the Riverwood Conservancy specifically, please give our office a call at 905-279-5878, or you can email info@theriverwoodconservancy.org to learn more about the various ways that you can connect with us and support our particular environmental initiatives. It looks like that is all the questions that we have for today. Carol, any last thoughts you want to share before we wrap up?
I just say thank you for having me on this great show. And what I would say is just think of yourself as a somebody who, for example, you are, there's an election and you're going to vote for the person that resonates with you, who speaks about changes and initiatives that they're going to bring into place that are in alignment with your values or what's going to benefit you and your children, and think about your money the same way. Before you go into the bank and just arbitrarily open accounts and you're invested in areas that are not in alignment with your values, think about your money that way, to know that you're supporting the gun industry. Think about these things and ask questions, because transparency is out there. You just have to ask for it. So
very, very good advice, and timely advice considering what is happening next week. So Carol, again, thanks very much for your time. To everyone who was joining us today, thank you so much. We appreciate it. Have a look at our website at theriverwoodconservancy.org for more virtual and in-person events coming up. And once again, our thanks to the Climate Impact Fund for helping make this presentation possible. So in the meantime, we will say goodbye for now, and please stay safe. We'll talk to you soon.
thank you. Bye, everyone.